Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz for the most exclusive access to leading economists and business leaders from around the world. Subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 9 in our series for 2025, and today's date is Friday, April the 4th. First, I'll be talking to Greg Zakowicz, Senior E-commerce Marketing Expert at Omnisend. He'll provide all businesses with great marketing tips in the lead up to Easter, which is the biggest sales event for this time of the year. And I'll be talking to Rabobank economist Michael Every about the impact of Trump's tariffs on China and how these will affect the global economy. But first, let's talk to Greg Zakowicz.
Well, Greg, how should people plan to do their marketing for Easter in 2025?
Yeah, so this is, it's an interesting thing because I think over the last probably 5, maybe 7 years, I think brands have really caught on that if there is a holiday, doesn't matter if it's a religious holiday, like a Singles Day that has kind of evolved, brands have realized that they can take advantage of that and start marketing. And the problem with like the Easter period is you have Valentine's Day, you have Mardi Gras, which is probably more US based than anything, but you have all these St. Patty's Day, you have all these holidays that kind of fall jam packed, and it's hard to really differentiate.
So, and it comes so soon after Christmas as well.
It does. It's nonstop, right? Those first couple months, it's just jam it all in. So, for brands, pick the holiday, start a couple weeks early, regardless of what it is. And there might be some overlap there. And that's when you just need to figure out, okay, what are we going to do here? Like, can we end this one early, shift over here? But for Easter, whether you have a religious audience or a non-religious audience, you can easily get away with that. You have your normal pastel colors, you have your normal, chocolate bunnies and the eggs, which people are synonymous with. Might have someone in their family who is religious if they're not, so they're still going to celebrate the day with them as a family thing. So I would lean into the family vibes, right? Show lifestyle images of get-togethers and warmth, use those pastel colors. I know for us, it's spring is around the corner. You guys are probably veering into fall a little bit, right? You're probably ending your summertime, but we'll see in the States, we'll see pictures of kids in short sleeve shirts and stuff. Lean into the bonfires and the warmth and all that stuff that it comes with it. So I would start with putting the feeling around the time period into the marketing. From there, I think you have a lot of variety because you don't have to sell the holiday, just sell the warmth and then promote your products, right? It's pretty simple. So if you're selling, pick a widget, cell phone cases, right? You could style your cell phone case for the season or let your friends see the new cell phone case and have these new things out there. I think the other thing that this is less of a Easter thing, but I think something that augments all this too is automated messages. So specifically your cart abandonment and your browse abandonment where, browse abandonment, think about your online window shopper. So if I'm there with your website, I leave without carting product, we can automate these messages, go off to me like, hey, Greg, saw you checking this out. Come on back, blah, blah, blah. But these are really good engagement pieces because they're self-segmented. They're based on user behavior, but they get people back to the site. And if you have your website that is, again, centered around this warmth, I think you're in really good shape there to capitalize the purchase intent, whether it's holiday specific, like religiously holiday specific, or just time period specific, which happens to be around Easter.
So you can use AI for that as well.
You can. So the automation's a little bit different than traditional AI, where you just kind of set up these basic rules. I say it's not as smart, but it's not quite as smart. It's a little more dumbed down, right? It's like, hey, we got a rule here. They cart a product, they leave. We'll trigger off an automated message to them right around those things. Now you can use AI in the scheme of like having we have a subject line creator tool or generator tool at Omnisend. So you can just go there and plug a Easter campaign, 10% off. It'll spit out some subject lines that I think will perform better for you. And you can use those, but I think it's less about AI and more about just the the dumbed down automation, for lack of better terms, right? It's still smart, but it's not AI.
Okay, but I mean, one of the keys in Australia is that around Easter time, families go off on holidays. So they go out to another part of the state just to take a few days off with the family and meet people. Some have holiday homes, go there, and so they get out. So your Easter messaging can encapsulate that as well.
Absolutely. So you think about the lifestyle side of things. So again, if you're selling that kind of family vibe or the vacation vibe or whatever it is, right? When you go on vacation, normally someone's going to find something new to wear, especially if they're getting together, going out to dinner, or if you're just kicking back, going to like a vacation home or something like that. Maybe want a new pair of swim trunks for the hot tub, or whatever it might be. Like, you can still sell those things. You can sell the vibe of it. I think the product is less relevant than kind of the mood that you set for it. So I think regardless of what they're doing, I think you can hit it. I'll give you a good example. So my kids' school their spring break comes around Easter time. So we're always gone on Easter. In the last couple of years, we've gone to Disney a couple of years ago, but we just got back from the Grand Canyon. So we went hiking in Arizona, and then we went hiking in the Grand Canyon for 4 days. We spent our Easter, hiking up a mountain, next to a big hole. So it was great, right? We still went to dinner. My wife still bought new stuff for the trip. We bought new stuff. The kids got new stuff. So again, we're just selling the environment more than we're selling the product. And if you can market it, the product then becomes, if you can set the stage, the product becomes somewhat irrelevant.
So if you go anywhere, really, for that, and to meet
I
up with
think so.
friends.
Yeah, absolutely. So people love wearing new outfits or having the new gadget or whatever it is with their friends. Get a new book to read when you're on vacation, right? But it's a conversation piece at that point. So whatever you think your audience has based on the products you sell, that's what you want to push for them, at least for the general part, and then let them filter themselves out of it.
The key thing that you've said in all of this is the timing. So you need, say, 2, maybe 3 weeks before to actually get people into the mood and remind them that Easter is around the corner.
I would say so. So I would say at a minimum 2 weeks. That's over here. We typically see about 2 weeks because we have Patty's Day on March 17th, right? And then anywhere from 2 to 4 weeks later, we're going to hit Easter. So typically once Patty's Day rolls around, then it shifts over to the Easter, those pastels and things. I would say 2 weeks minimum. Now, if you find like Australia, for instance, you're saying a lot of people go away on holiday and stuff around the time. To your point, 3 weeks. Start getting going early. You can never be too early for these things.
What's interesting is that, in Australia, around about Christmas time or just after Christmas, you have supermarkets selling hot cross buns, getting people into the mood for Easter, which is reminding them, hey, we've just had Christmas, but Easter's around the corner. So you'd expect supermarkets would do that to make a buck.
My guess is they wouldn't do it if it wasn't selling, though, right?
Yeah, absolutely. Absolutely. But the timing is interesting.
It is. And I'm sure this is the same by you, but Christmas over here, not even the marketing side of things, but you talk about stores and things like that. So like your big box retailers like Home Depot and Lowe's over here, right? It used to be mid-November, the Christmas displays would go up and that's half the store. And then a couple of years ago, it was November 1st. It was September this year. I walked in there and half the store is Christmas and I go, holy cow, So they had 4 months. I'm sure you're seeing the same thing by you as well, but it just speaks to the point where you're getting people like you're setting that stage, you're getting them in the mood. And if people don't want to buy, they'll wait. But those that want to buy, they're excited about it and they jump in and do it.
So the timing doesn't really matter. I mean, you could do it well before Easter.
You could. I think the sweet spot for most brands is going to be that 2 to 3 weeks before. I think that's where you'll typically find the most success with it. But to some degree, I would say you're right. I don't think it matters as a whole, but I think you also need to look at the products you're selling and going, okay, are we going to market around XYZ holiday, Valentine's Day? Are we going to do this? That's going to naturally break up your cycle a little bit, I think. So again, I think your 2 to 3 weeks is going to be your sweet spot for most brands, but always exceptions to those rules.
Well, if you're a small to medium-sized business, 2 to 3 weeks would be ideal. Of course, if you're a big retailer,
Yeah.
it would be very, very different, like Home Depot or anything like that. That'd be very different there.
Very much so. Yeah. It's funny because a lot of small businesses too, like 3 weeks from now is like an eternity for them, right? They're just kind of living day by day to get these things out the door and stuff like that too. So there's some nuance there based on the size of the business as well.
So the advice for business is to get in early, get people in the mood, and get the right stuff out to promote your business and to use some automation.
Yeah, and I think 100%. And I think the automations that kind of catch all there. What I think is important about that is, right, there's certain automations that just perform better than other ones, right? As we talk about those high intent ones, so shopping cart abandonment, stuff like that. But I think we're like browse abandonment and cart abandonment to some degree, but we're browse abandonment messages. So those are your online window shoppers that leave. I think those are important because if you're out there shopping for Easter stuff 3 months before and you abandon and you're not ready to market to Easter yet, as a company, that automation will trigger and target you specifically and get you back to buy your Easter stuff while you're not doing the other things, right, as a whole. So those things kind of fill in the gap a little bit as, okay, we're not ready for this or we're not ready to go, 100% this way. But for Leon and Greg, who are coming over here and they're checking those things out, we're going to have that specific message go directly to them and we're going to get them through.
So you're there 24/7, even if you're not.
100. Yep, that's right.
Okay. Well, Greg, it's been a delight talking to you. And thank you so much for your time and your flexibility.
Oh, no problem, Leon. Thank you for making the time and for agreeing to do this.
And now let's talk to Rabobank economist Michael Every.
Michael, what's your reading of how China's going to be responding to these tariffs, whatever's going to be happening on April the 2nd?
Well, it's very hard to say. It depends not just what happens bilaterally between the US and China, but what happens between the US and everybody else, which is one of the reasons why almost no one is modeling it, because economists love trying to artificially model very simple bilateral relationships, but that's just not how the real world works. I mean, we've got so many other trade players involved in this matrix, and what the US does or doesn't do versus all of them relative to China will probably help determine to an extent what China does. I mean, their worst case scenario is that the US makes it really clear that they're in a bad boy basket with only a few others, but everyone else is offered a negotiable package whereby US tariffs against them can be traded off if they agree to a joint external tariff against China. That's still a thesis I'm putting out there. And if that happens, that's a world of hurt for China. That's most of the Western world turning around and saying, yeah, okay, fine, we'll trade with the US, but we won't trade with China so much. But on the other hand, if it's the US against everyone, China isn't so individually aggrieved or individually threatened. And if it's complete uncertainty, I guess they'll just wait and see. So I'd love to give you a clear answer. We'll have to wait until April 2nd to find out. But one thing is absolutely crystal clear, as I've said to you time and again over the years when we've spoken, that we are coming to the crunch point now. This is no longer just hypothetical and tail risks here, and here at some indeterminate point in the future. It's looming.
The problem is that so much of the rest of the world trades with China. China supplies so much of the world's goods.
Yeah, because free trade theory and useful idiots in economics departments and foreign policy teams and trade negotiators have built a global system using cheapest is best, free trade is best thinking, which has de facto cemented China as the core of the entire global production process. I mean, let's just put it in perspective again. In the year 2000, China was 6% of global manufactured goods, 6%. By 2030, on the current projection, if we don't have these tariffs coming up, it will be 45%. So nearly 1 in every 2 manufactured products of every sort globally will be made in China within the next 5 years. And if you want to just say, yeah, well, what are you going to do? Because markets, absolutely fine. But then understand the political quid pro quo that comes from that. Who has all the power if they make 50% of all the goods? And it doesn't stop there, by the way. That trajectory moves up to 60, 70, until eventually China makes just about everything. And then, well, as I said, do the political math yourself on that.
And one of the other issues too is that it's so unpredictable.
Well, no, it's completely predictable. It's completely predictable. I have predicted it over and over again to you over the years, Leon. You'll excuse my frustration. I have pointed out exactly the glide path that we're on, even if I haven't used that particular metric before. I've made it abundantly clear that just saying, yeah, what you're going to do, free markets, yada, yada, neoliberalism is a nonsense machine that has no understanding of the real world around it. And if you presume or interject for one moment that there might be political or geopolitical frictions between the economies that are seeing those trends develop, you know that you're heading for an absolute tsunami when you get there. That's been eminently predictable for years, and I have done so in print and on this particular podcast. It's not my fault if nobody bloody listens and just keeps saying, yeah, it's cheap because markets. So now it's completely predictable we have a tsunami. We just don't know exactly when it hits, how high the water is, and how many locations it hits and first. Everything else is basically already predetermined. And I don't want to be a Marxist and say that, you know, the future is already written. But I don't see how we get out of this at this stage.
What I was alluding to was, yes, of course, it is predictable. And you have said this many times, but Trump himself is unpredictable because, like, he'll say we're going to bring in these measures, such and such tariffs, and then he'll completely change it.
Well, that's true. I mean, the near-term volatility we have is unpredictable, but that doesn't really matter. I mean, I know it's easy for me to say that when I'm not importing a widget and looking at a potential tariff shift, adding, you know, $50,000 or $100,000 to a particular shipment. I get that. It's easy to say it from a helicopter view. But all that Trump is doing is flailing around, either with a strategy or without. I presume there is, to try and rectify the dynamic that I was just describing to you, that you cannot have China making 45% of the world's manufactured products within the next 5 years, moving up to 55, 65, 75 inexorably, and maintain any kind of Western economy, which A, has any kind of blue-collar work, or B, has any kind of ability to produce its own defense goods, either in Europe or America, at which point then you don't really have much geopolitical power, do you? Because you can't make anything. So that has always been predictable. And again, excuse the slight tension in my voice, but we have just, as I said, been absolutely led here by a cohort of people who don't understand anything, running key institutions, governments, big businesses, etc., who have learned nothing from history, never read any economic history, and just presume she'll be right and look to the next quarter. Well, since when has that ever run the world well? Ever.
The issue then becomes, what's your forecast for how this will all pan out? I mean, over the next 5, 10, 20 years?
Well, I've already used the word tsunami, and one can't get too granular in terms of, you know, what color the seawater will be, what salinity it will have, what kind of aquatic species will be swimming in that particular body of water, or which shores it will hit, where or when, precisely, because it's very difficult, as I said earlier, to compute exactly where it will go. But if you are logically saying, and I have done, that the West will not stand for this. I was saying that before Donald Trump was even in politics, that eventually the Americans would elect someone who would say, let's look at our past when they had very high tariffs in order to industrialize versus the British and Europeans. And they would say, now we need to re-industrialize versus the Chinese and the Europeans, which is exactly what's happening. That you will have nothing but volatility because one side or the other has to give. It is now zero sum. It's not positive sum. It's not the nice, happy, clappy story you get sold by economists talking about, you know, you don't get rich trading with yourself and, you know, let's just sell a bit more of this and buy a bit more of that. Only one person is going to be able to have a very large share of the global manufacturing product base. And Europe is doing exactly in its own sweet way what America is doing. Europe is talking about the fact that it wants to uphold the global rules-based order as America walks away from it. And that's absolutely fine. But overnight, you had the European Commission say they want to be a central arms purchasing repository for all of the European Union and an arms cache member states can dip into. Like, I need 5 planes. Okay, take them out of the warehouse. I need 500 tanks. They're in the warehouse. Which is impossible to do with free trade because they're not going to be a central repository that buys imports from America to do that. They're going to make them in Europe. And so they're going to have to raise tariffs and seal off a large percentage of their industrial base to produce defense goods to be stockpiled just for Europe. And I tell you this, Australia will end up doing exactly the same thing.
So we're entering a completely new economic paradigm.
Yes and no, It's not new, it's old. It's the way the world always was. The new quote unquote paradigm was the one we had from the 1980s, or technically the very late 70s, right the way up until some people would say 2012, some people would say 2008, some people would say 2016, some people would say 2025. Future historians will argue over the precise turning point. But where we are now, approximately on the historical scale of things, where everyone, and I mean everyone, recognizes that what was doesn't work. It can't be sustained politically, and it won't be sustained politically. So I'd love to have a granular view for you, but all I can tell you is that things will change, and they will change as dramatically for a whole cohort of Western bureaucrats and politicians and business people and markets traders as they did for a better educated cohort of Soviet technocrats in the late 1980s who knew that their system had problems, were trying to introduce glasnost and perestroika to reshape it while maintaining its global template, and were then surprised when everything collapsed, and a lot of them found themselves literally talentless and useless overnight, and others, of course, became billionaires by spotting the trend and riding it out. And exactly the same thing will happen here. Some people will be big winners if they can spot the trend, and lots of people who think they've just got a nice, comfortable living within a system that works for them will find they don't. And I'm exaggerating just to make the point, but that is very much the trend that's playing out. And the upside should be clear, and the downside should be clear.
Well, that's all quite worrying and illuminating.
Or good, or extremely extremely full of enthusiasm, if you call it right.
Indeed. Well, Michael, thank you very much for your time.
Thank you, Leon. Have a great day.
So what's happening in the news? Well, a study from Aston University in the UK has found that a trade war triggered by President Donald Trump applying a 25% tariff on all imports could cause a $1.4 trillion hit to the world economy and dramatically drive up US prices. In a fully blown trade war where partners retaliate to match Trump's tariffs, the US would experience the worst inflationary effects of any nation, according to the research. It would send US inflation up to 5.5%, higher than any other nation. Jun Du, a professor of economics at Aston University, said the modelling showed that if countries imposed tariffs on 25% on each other, it would have similar effects to the 1930 trade war that deepened the Great Depression. These findings align with historical precedents like the Smoot-Hawley tariffs and modern trade conflicts, illustrating how protectionism erodes competitiveness, disrupts supply chains, and imposes disproportionate costs on consumers, she wrote. In the hypothetical scenario, where the war is confined to Canada, Mexico and China responding with a 25% tariff against Trump-imposed tariffs, all sides experience a sharp drop in trade of more than 30%. The study reaffirms that no economy emerges unscathed from systemic tariff escalations as retaliatory spirals fracture multilateral cooperation and amplify global instability, Du said. And concerns are growing about Trump's tariffs, with Goldman Sachs raising the probability of a US recession to 35% from 20%. The brokerage also lowered the world's largest economy GDP growth forecast for 2025 to 1.5% from 2%, and projected 3 interest rate cuts each from the US Fed and the European central banks from its previous expectations of 2 each, as President Donald Trump roil the global economy and upend financial markets. Europe is expected to fare worse than the US, Goldman warned, as it projected the region's economy could enter into a technical recession this year. The brokerage forecast little growth for the rest of 2025, with non-annualised growth of 0.1%, 0% and 0.2% in the second, third and fourth quarter respectively. Goldman Sachs expects Trump to implement a reciprocal tariff on the European Union amounting to 15 percentage points, raising the total effective tariff by 20 percentage points. We estimate that our new tariff assumptions will lower euro area real GDP by an additional 0.25% compared to our previous baseline, for a total hit to the level of GDP of 0.7% compared to a no-tariff counterfactual by end of 2026, Goldman said in a separate note on Sunday. However, in a more downside scenario of tariffs, Goldman sees a total hit of 1.2% to the EU economy, which would push the euro area into a technical recession in 2025, compared with a no-tariff scenario. For sure, eyes were on the Reserve Bank board meeting this week, but of course the RBA, as expected, kept rates on hold. There was no April Fool's Day cut. So instead, the eyes of business and the market will be on Trump's tariffs, which will be announced on Wednesday, US time. For what it's worth, Trump calls it Liberation Day, and it will will be the biggest round of tariffs yet. We already know that Australian steel and aluminium producers have already been hit by 25% tariffs, but so-called reciprocal levels could impact all export industries. That's particularly if Trump follows through on his threat to treat Australia's 10% goods and services tax as a trade impediment. And Australia is tipped to incur a new round of American tariffs on exports, including $7 billion in farm produce, after the federal government rebuffed demands from US President Donald Trump to overhaul pharmaceutical subsidies and weaken biosecurity rules. Farmers have been told to expect tariffs of 10% or more on beef and other products after talks with the Trump administration reached an impasse. Anthony Albanese ruled out a deal with Trump to adjust domestic policy in response to the US complaints, which include claims that American exporters cannot ship food to Australia due to biosecurity checks on pork and other products. Not on my watch. On my watch, our biosecurity system is essential, Albanese said. And the Reserve Bank of Australia has warned that uncertainty about the outlook abroad remains significant. In its announcement on the RBA's decision to keep rates on hold, the RBA said, on the macroeconomic policy front, recent announcements from the United States on tariffs are having an impact on confidence globally, and this would likely be amplified if the scope of tariffs widens or other countries take retaliatory measures. Geopolitical uncertainties are also pronounced. These developments are expected to have an adverse effect on global activity, particularly if households and firms delay expenditures pending greater clarity on the outlook. Inflation, however, could move in either directions. Many central banks have eased monetary policy since the start of a year, but they have become increasingly attentive to the evolving risks from recent policy and developments. In a press conference following the decision, RBA Governor Michelle Bullock said tariffs would slow global trade, and that would have implications for Australia. Australia, as a small open economy, has benefited massively from open trade, so it's not good for us. A world trading system that is fragmenting, that's not good for us, the RBA Governor said in a press conference. The immediate impacts in terms of fragmentation, stopping trade, increasing price levels, they'll all be felt, but the issue of longer-term impacts, that is going to be quite dramatic. Keeping the cash rate on hold was a consensus decision by the board, Ms Bullock said. The impact on Australia's inflation at this stage was less clear, she added, but all things being equal, tariffs meant higher prices. And Beijing's top diplomat has urged Australia to work closely with China in defiance of US President Donald Trump's tariff war. China's ambassador to Australia, Zhao Shen, said China and Australia were beneficiaries of free trade and should work together with the international community to support globalisation, uphold the international trading system and promote trade liberalisation. The United States' imposition of tariffs on multiple countries, including China and Australia, seriously tramples the international free trade system centred on the World Trade Organization, Zhao said. And in a stinging report, the Australian Securities and Investments Commission found that super funds tend to be out of fraction with death claims. ASIC found 78% of claims reviewed had delays caused by processing issues within the trustee's control. For instance, the $93 billion industry superannuation fund, REST, paid out just 8% of death claims for a deceased member within 90 days. Public sector fund Commonwealth Superannuation Corporation had a 10% completion rate at the 90-day mark, followed by Brighter Super on 20%, Hester at 21% and Host Plus at 22%. UniSuper outperformed other industry funds, ranking second out of the 10, with 41% of its beneficiary claims ruled off after 90 days. Retail funds NM Super, representing AMP, and Nulis MLC Super were third and fourth, followed by Australian retirement funds. ASIC found industry funds were the worst offenders in delaying payouts after examining 2 years' worth of claims. And in bad news for the Australian economy, commodity exports are expected to fall almost 7% this year. The latest quarterly figures from the Department of Industry, Science and Resources highlight the impact of slowing commodity prices and increased global market supply on Australia's mining sector. The March Resources and Energy Quarterly Report found that Australian resource and energy commodity exports are expected to fall from $415 billion to $387 billion this financial year and to $343 billion in the next 5 years. The report also found that the price of iron ore, Australia's biggest export commodity, is expected to average US $86, that's $137 Aussie, per tonne this financial year, down from US $103 last year. And an important piece of news which is likely to transform the media in Australia, Domains Board has approved Costar's Group's offer to acquire 100% of the real estate platform company, subject to due diligence after the US Group increased its offer. The US-based Costar has a market cap of over 50 billion Australian dollars and runs Homes.com and Apartments.com, two of the top listing sites in America. As part of the deal and as a condition of the proposal, Each of Domain's directors, include those from Nine Entertainment, must unanimously recommend Domain's shareholders vote in favour of the scheme of arrangement in relation to the transaction in the absence of a superior proposal and subject to an independent expert, continuing to conclude that the transaction is in the best interest of Domain shareholders. The deal requires approval from the Foreign Investment Review Board. As a 60% shareholder in Domain, Nine Entertainment stands to clear $1.4 billion if the sale goes ahead. This will allow it to clear its $628.5 million debt. The question then is what happens to newspapers like The Age, the SMH and the Australian Financial Review. Domain provides 29% of Nine's earnings, the biggest contributor after television. With a financial windfall after clearing its debt, Nine might choose to reinvest in its media assets, including its newspapers, or it might explore new opportunities in digital and streaming platforms and shift its focus away from traditional print media. One suggestion is already coming from MST marquee analyst Fraser McLeish, who named outdoor firm All Media as a potential target. And Rupert Murdoch's property listing empire, REA Group, which is not part of News Corp, faces a brutal shake-up of its lucrative business if CoStar does end up buying Domain. REA Group is significantly larger than the Domain Group in terms of company size and market presence. REA Group has over 2,800 employees across 3 continents, whereas Domain Group has around 750 employees. Additionally, REA Group has a market capitalisation of $30.72 billion. That makes it more than 10 times the size of Domain, which has a market cap of $2.76 billion. REA Group also operates internationally, with investments including in multiple countries, while Domain Group primarily focuses on the Australian market. REA's domination is so overwhelming that analysts at Morningstar suggest increased competition from CoStar would allow REA to increase prices even further without regulatory scrutiny. And Telstra Chief Executive Vicky Brady has warned that women could miss out on the AI revolution because they're often not as keen as men to take a risk and move into new areas, underscoring the risk of a new gender gap forming. Ms Brady said diversity and flexible work were fundamental to Telstra's operation, so was part-time work. 6 out of 10 part-timers at the telco were women. And Macquarie CEO Shamara Wickramanayake said diversity is good for business, despite it now being woke to be anti-woke. Meanwhile, former PayPal chair and veteran company director Bonnie Bozeman has called for more women to take up golf to help smash the glass ceiling and male-dominated leadership. Ms Bozeman, a founder of the Chief Executive Women 40 years ago, who is a director of the Australian Golf Foundation, told the 1,300 guests at the Chief Executive Women's annual anniversary dinner in Sydney that she wanted women to pick up the game of golf and challenge what had long been the domain of men in business. Bozeman, who funds a scholarship program to help school-age girls play golf, said, "I wanted them to have a skill to be on the same footing as men. But artificial intelligence is threatening to derail the chances of women being on par with men even before they step on a golf course." Women in Digital founder and CEO Holly Hunt said women were in general more cautious about using AI than men. Women are quite anxious about using it correctly. In my research, women are 16% less likely than men to use AI tools, and I think that speaks to that, like risk aversion and wanting to make sure that it's being correctly applied, Ms Hunt said. Ms Wickramanayake defended Macquarie's diversity policy, saying, "We don't do diversity because it's woke. We do diversity because it's good business. We live in a world nowhere it's woke to be anti-woke." She said one of the big issues in ensuring diversity at Macquarie was that only 35% of applicants were female. Girls and women were opting out because they were not attracted to jobs in finance and did not have many strong female role models in the sector. The bank lost more female talent as women began having families and at the senior levels, and only 10% of jobs were held by women. And that's it for this week. And I'll be taking a break next week. In the week of April the 18th, yes, Good Friday, I'll be talking to Professor Ben Rogue from University of New South Wales Science on the Pact for Impact, an initiative that strengthens partnerships between academics, industry and the broader community by ensuring the real-world impact of scientific research and development. And I'll be talking to EY Regional Chief Economist Sherelle Murphy about the spending promises and patterns for the government in its budget and the opposition's promises in terms of fiscal restraint and what the economy needs. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can find me on Facebook, Twitter, or X as it's now known, Instagram, LinkedIn and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Looking forward to bring you the episode of Talking Business on April the 18th. For your Easter enjoyment.